Okay, hello and good afternoon to all of you. So welcome to today's virtual class, and we will be doing a very important our syllabus, and that is value of money. I thank you for all the queries and the responses you have sent with respect to the last class we had. Now we have received altogether more than 400 queries and responses and your feedback. So I thank each and every one of you for participating actively in the class session. And we have filtered the responses, and I will come up with my answers to your queries after some time. I will first start with some calculator tricks. You have stated in the response box, in the query box, that you wanted to know something about calculator tricks. First of all, please note that scientific calculator is not allowed in the exam, so I will discuss about it. Then we shall move into the time value of money. Time value of money. And today we will be covering the, because time value of money, we have got 3 classes. And we will do the first part to okay, so we were discussing about how to use shortcuts using the calculator. Please note, only 12-digit calculator will be permitted in the exam as per the current regulations of ICAI for the CA Foundation exam and thereafter. Scientific calculator is not used, and I will be discussing about 3 or 4 shortcuts while using calculator. The first is when you want to go for repeated calculations, so you press the button, say it is a addition or subtraction or multiplication. So you press the button 2 times and ultimately you will be able to complete in the shortcut method. Use of gross total, now while especially for numericals involving interest, or when we learn about NPV, that is net present value, which is going to be covered in this time value of money chapter. Net present value is a very important concept which we are covering in second day and third day of the time value of money session. Now, for these type of calculations, repeated use of gross total has to be carried out, and you will see that there is a GT button in your calculator, and if you want to say, for example, I am showing some calculations, say calculation number 1, you have done 10 plus 20 equal to 30. Then you are doing calculation number 2, 30 into 2 equals 60. Calculation number 3 is 30 minus 10 equal to 20. Or say 30 minus 20 equal to 10. 30 minus 20 equal to 10. So if you press the gross total, once you press the gross total button, what happens is these 3 numbers get added. So automatically you have the addition for 30 plus 60 plus 10, so you get 100. Okay, so this is how to use the gross total button in your calculator. The third is use of memory functions. Now, you know that in case of memory, you have M plus, M minus and MRC. So you have 3 buttons for addition, for subtraction and for recall. MRC stands for memory recall. So you have these 3 buttons. Now say you are doing 10 plus 30. So you have done 10 plus 30. This equals 40. Then you are doing 100 minus 50 equals 50. 30 minus 10, or sorry, 30 minus 20 equal to 10. 20 plus 30 equal to 50. And say for example, this 10 plus 30 equal to 40. This is going to M plus. This is going to M plus. 100 minus 50 equal to 50. This is also going into M plus. You want to add them later on. 30 minus 20 is 10. Say you want to subtract, so it goes into M minus. 20 plus 30 equal to 50. Say you want to subtract it again, so it goes into M minus. So after these calculations, if you press the MRC, that is the memory recall, you automatically get 40 plus 50 minus 10 minus 50, that is 30. So this is how you can use the shortcuts. And also when you want to multiply, say for example, you want to multiply a number multiple number of times, right? So say for example 20 into 20. So 20 into 20. So what you do is you just press 20 and you press the multiplication sign and then you give the equality sign, automatically you will get 400. So in this way you can use some of these shortcuts which will help you in your exam. It will save the time, and these are shortcuts which are to be used for your calculation. Please remember, many of you have asked the question whether scientific calculator is allowed. No, scientific calculator is not allowed in the exams. Okay, now we move on to our discussions of the time value of money. Now today we are going to cover, in the time value of money, we are going to cover the concept of simple interest. First of all, what is interest we will learn. Then how to go for simple interest calculation. Then we have compound interest calculation, and we will also learn the difference between simple interest and compound interest, and effective rate of interest. Effective rate of interest. So this is basically the program for today. This is the first day. Second day we will discuss about annuity payments, annuity receipts, and concept of present value. Right? So this I am keeping for the next day. This chapter is very, very important for your exams, because every year, as I said earlier also, 20% to 25% of the questions from the mathematics part is going to come from time value of money. It's a very, very significant chapter in your foundation curriculum. So please go through the entire chapter, understand each and every aspect, and the numericals are direct questions, not very tough, because these are based on simple formula. So if you remember the formula, it is true that you will be able to give correct answers and you will not be losing marks. And this chapter is based on a lot of concepts. So we shall be discussing each and every concept, like simple interest, compound interest, compounding interest quarterly, half yearly, annually. Then we shall discuss about the effective rate of interest, annuities, present value, discounting, etc. So this is very important. And we will also do calculation of returns. And on the last day, we shall be discussing about the applications. The applications of this particular chapter in the field of leasing. You might be knowing that we take, say for example, a car on lease. We take a house on lease. Aircrafts are taken on lease. So leasing decisions versus buying decisions. Next is bond valuation and capital expenditure. So these will be taken on the third day. This is a big chapter. This is a long chapter. So we have got 3 days so that we can devote equal time on all the portions of the syllabus. Okay. We shall also do many problems from the study materials, from the additional question bank, and from the MTP, that is the model test paper, and exam questions of the past years, previous years exam questions. First is we come to page 4.2. So page 4.2 of the study material. So I request you to open page 4.2 of the study material. Page 4.2 of your CA study material. We start with this 4.2. The first point is what is interest and what is time value of money. Now the chapter is time value of money. Friends, think of a person, a student who is appearing for CA final. Say I am a student appearing for CA final and I am supposed to appear in the month of November 2020. Now if I fail in the exam, in spite of my efforts, say due to some reason I fail in the exam. So I was supposed to appear in November 2020, but I have failed. I could not pass. So I have to appear in May 21. A gap of 6 months. Right? Question is, if I pass, say I pass in May 2021, but there is a gap of 6 months. I become a chartered accountant after 6 months. I pass the exam after 6 months. Do you feel there's a difference between passing in November 2020 and passing in May 2021? What do you feel? Yes, this is the time, a gap of time. And even if I pass in November 2020, that means in January I get my results. Assuming that I'll be getting a salary of rupees, say 60,000 per month. If I'm able to pass in the CA exam 6 months earlier in November, I can start my career earlier. I get a job. If I want to do a job, I can get into industry. ICAI has a very good campus placement system. So I can get a job, and even if I assume a very, just a assumption is that if I get the average salary of say 70,000, or let's take a conservative view, 60,000. I shall be earning 60,000 into 6, that is rupees 3,60,000 in a matter of 6 months. So there's a difference between passing in May and November. So this is the first concept of the time value of money. If you pass early, then definitely you start your career early. Okay, now we go to the main example. So time value of money means what? It is the fact that if I give you rupees 1,000 today, say in July 2020, and if I tell you that I will pay you 1,000 rupees in the month of November 2020, both the amount is 1,000. I am giving you an assurance that either I will pay you 1,000 rupees in the last week of July, or I will pay you 1,000 rupees in the first week of November, or sometimes in November. Does it make a difference to you? In both the cases, you are going to get 1,000 rupees. I am going to pay you 1,000 rupees. But is there a difference? The answer is yes. If you get 1,000 rupees in July, then you can invest that money. Say for example in a bank. Right? In a bank you will be getting interest. You will be getting interest. Say at the rate of 4%. 4% per year. 4% per year. So you are going to get 1,000 rupees in the month of July, and you will invest the money in a bank account. You will be getting 4% per annum, which means 1,000 rupees, 4% per year, which means you will be getting rupees 4% of 1,000. How much is that? So 4% of 1,000. It is 25. Okay. So the question is, 4% of 1,000, 40. Okay. So you are going to get 40 rupees, 4% of 1,000. The question is, in 3 months time, because you are getting the money in July and I am talking about November. In 3 months time, July, August, September, October, November, in 4 months, this is what you will be getting in full year. But in 4 months, you will be getting 1/4 of this. So you will be getting 10 rupees. That means you have 10 rupees more. So the time value of money means that if you get rupees 1,000 today, or if you get any amount today, it is always better to get the money today, because you can reinvest the money in a bank, in the stock market, in a bond, in a mutual fund, and you will be getting some returns. So the time value of money means that money fetches different levels of interest, different amount of interest at different points of time. So the time value of money discusses techniques by which we can find out what is the amount of interest which I shall be earning if I keep the money in a particular bank account, or if I keep the money in a fixed deposit, or if I keep the money in a recurring deposit in a bank, or if I keep the money in business. How much will I earn? What is the return? So this chapter is not just important from mathematics point of view, but this is very important even from the business point of view, and that is why this chapter is going to help you even in financial management paper, right? So this is the time value of money. Now please remember that money has an opportunity cost. If a bank gives me a loan, they want me to pay interest. I have to repay. You know that when the bank gives me a loan, say rupees 1 lakh, they give me a loan of 1 lakh rupees. They expect me to pay interest. Now why am I paying interest? This particular page 4.2 of the study material discusses why interest is paid. Why is interest being paid by me? If I take a loan, I have to pay interest. Why? Because the bank has an opportunity cost, right? We call it opportunity cost. Opportunity. What is opportunity cost? If they have not given me 1,000 rupees, if they have not given me the loan, they could have given that money to somebody else. They could have invested the money somewhere else and they could have earned some return. Okay? So opportunity cost means the return you will get. What is opportunity cost? The return you will get if you invest the money in an alternate mode, alternate method. So instead of giving me the loan, if the bank could have given the money to somebody else, they could have got some return, right? Say for example, somebody leaving his job and coming into business. Say he was earning 1 lakh rupees per month in his job. Now he is starting his business. What is his opportunity cost? His opportunity cost is 1 lakh rupees per month because he could have earned 1 lakh rupees if he had stayed back in his job. You know, due to the lockdown, due to the pandemic, the World Bank has said that 1/5 of the working population will lose their jobs. 1/5, that means 20%. Out of 5 persons around the world, 1 person out of 5 persons will be losing their job. And many companies already have downsized. They have said that we cannot pay you. There's no business. We are not earning money. There's no revenue. So I cannot pay the salary. And you may be knowing that 2 of the industries which have been hard hit due to the lockdown, due to the COVID-19 is the tourism sector and the aviation sector. Because all the international borders are sealed, so aviation business is down. Many of the employees in the aviation sector are losing job. Say I am an employee in an aviation company. I have lost my job and I want to start my business. What is my opportunity cost? The opportunity cost for me is the return I could have earned if I had stayed back in that job. If I could continue in the company, I could have earned 1 lakh rupees per month. So it is my opportunity cost. That means everything has an opportunity cost. Similarly, when a bank gives me a loan, they are thinking that, well, if I give a loan to Mr. Arijit Chakravarti, what happens if he does not pay? If I had kept the money in some other investment, if I had kept the money for some other purpose, I could have got some returns there. So this return will be the opportunity cost. I hope it is clear to you. Every action which we take in life has an opportunity cost, and in financial management, in business mathematics, opportunity cost is very important concept. Even in economics, you must have read about opportunity cost. Now, another important reason, so if you talk about why interest is paid by us when we take a loan, there are 4 reasons why interest is paid. So there are 4 reasons. First is what? Because there is something called TVM, time value of money. Time value of money. The second is what? There is an opportunity cost. The third is that there is something called inflation. Inflation. That means if you invest, say for example, I am giving a simple example. You have seen that in the last few months, fuel prices have gone up. Inflation is what? What do you mean by inflation? Inflation means the general increase in the prices of commodities. At the same time, it is true, yesterday if you see, some of you must have seen the update in the media channels, different channels, that gold, the value of gold has come down. Why? Because the demand for gold has come down, so the price also has come down. But in many cases, normally the prices of commodities go up. And that is called inflation. So if a bank is giving me a loan, they want interest payment from me because the money they have given to me 5 years back. They must earn some return because they have to cover the inflation. Right? Normally in India, if you see what is the approximate amount of inflation. Now, in the last 2-3 months, the Reserve Bank of India has stated that the inflation in India is around 5% to 6%. That means last year, if the cost of a particular commodity was 100 rupees, this year the cost has increased by 5%. This year, the cost of the particular commodity will be 105 rupees. So there's a 5% increase. This is inflation, and this is one of the reasons why interest has to be paid, so that the money which I am enjoying, the money which I have taken from a bank as loan, I am using the money maybe for my housing purpose, for my vehicle, I have taken a car loan, for my higher education, for financing my business, whatever use I do with that money, the bank must be able to cover the cost of inflation. So this is the reason. And last, of course, is liquidity. Liquidity preference, which means that ultimately you must earn something more so that you have enough liquidity. So these are the reasons why interest is paid. Now we come to the next point, and that is, therefore, the time value of money. I think you have understood that the money received today is much better than the same money which I'll be receiving 6 months from now, because I can invest that money for 6 months and I can earn some interest. I can earn some return on that money during these 6 months. So it is always better to get money today than tomorrow. That means here tomorrow, I mean to say 3 months, 6 months, 1 year. Right? The sooner I get some cash flow, the sooner I get some funds, I can invest the funds in some, avenues, in some way on which I can earn some return. So this is basically the concept of time value of money. Now we come to something which is very simple. You have learned it long back in school, and that is interest. We have looked at interest. So what is interest? Interest means the cost which I am bearing. I have taken loan from a bank. I have to pay interest. Why? Because I am using the money for my business purpose on which I am earning something. I am using the money to buy a house. I am using the money to finance my education. I am getting benefit out of that money, and I have to pay back to the lender some sort of return. That is interest. Now you know that interest is something very simple. We call it simple interest. Simple interest. So we have principal. First point, principal. Principal is what? The sum of money which has been given as a loan. So I am investing, say, rupees 1,000 in a bank, fixed deposit. FD, fixed deposit. I am investing rupees 1,000 in a bank fixed deposit. The bank is paying me some interest. Why is the bank paying me interest? Because I have kept the money with the bank, and the bank is using this 1,000 rupees and investing it in different stock markets, in property market, in commodity market, and the bank is earning some return. So they have to pay me some sort of interest because I have kept the money with them, and since I have kept the money with them, I cannot utilize this money. I cannot invest the money in some other area, in some other way. But I have an opportunity cost. I could have used this money in my business. I could have earned some return. So the bank considers all this and pays me interest. Now say the interest is 6% per annum. What do you mean by per annum? It means per year. In 1 year. So the bank is paying me 6% interest per year. Okay? So at the end of 1 year, what is going to be the amount? So this is also called what is going to be the accumulated balance. Accumulated balance. So let's call it AB. Accumulated balance. Let's call principal equal to P and the interest is I. Okay? So how much will I earn? The formula Please write it down. It is given in the study material also, as I said, page number 4.2, 4.3 we are doing. So the formula is the interest which I will earn is equal to the principal amount multiplied by the interest rate. Interest rate I, in this case it is 6%, multiplied by the time t. T is the time. So t is the time. So we are dealing with three figures. Okay. The first is the principal amount. I have taken a loan of 1,000. I have invested 1,000 rupees in a bank. The bank is paying me interest at the rate of 6% per year. 6% per year. And at the end of 1 year, we are trying to calculate how much interest I will be getting. Very simple. The formula is interest is equal to principal into the interest rate into the time, and the time in this case is 1 year. So the time is 1 year. So what is going to be the interest here? So interest will be 1,000 into 6%. You know 6% means, if you put it in decimal, it is 0.06. 6% is 0.06. So 1000 into 0.06 into time. The time is 1 year, so into 1. So how much is this? 1000 into 0.06 into 1. Okay, so this is 60. So the interest which I am earning is 60 rupees. Right? So what is my accumulated balance at the end of the year? I started with 1,000 rupees. I invested the money in a bank. I earned 60 rupees on the money. So I have at the end, how much? 1,000 plus 60, that is 1060. So at the end of the year, my accumulated balance becomes 1060. Okay. So this is the concept of simple interest, where the interest is equal to the principal amount. Principal means the money which is either invested or the money which is given as loan. I, that is the interest rate, and T, that is the time during which the money is invested. Right? So P into I into T. So in this case 1000 into the interest rate 0.06 into 1 year. So you get 60 rupees, and therefore the accumulated balance is 1000 plus 60, which is 1060. So please remember, this is the simplest form of equation, and some of these questions every year it comes in the foundation exam also. Even questions on simple interest comes in the foundation exam. So from here we can write two formula. I request you to note the two formula. Okay. So please keep pen and paper with you and let us learn together like the other days also. So first one is, we know that accumulated balance, that is A or AB, whatever, let's call it AB, accumulated balance, let's call it AB. So AB or A, whatever, some of us in the study material, they are calling it A, so it can be A, AB, whatever. So this is equal to principal plus interest. This is the first formula, number one. The second formula is interest I. This interest is equal to principal multiplied by small I, that is the interest rate, into T. T is, you know, the time, and I is the interest rate. Okay? So this is the second formula. Okay? So if A or AB is equal to P plus I, then from this equation, so from equation number 1, we can write that A equal to P plus I, therefore A minus P equal to I. So the accumulated balance, AB say, AB minus principal gives you the interest. So this is the third formula. So you have to remember in simple interest, three very basic formulas. Amount or accumulated balance is equal to principal plus interest. The interest is equal to principal into the interest rate into the time for which the money is invested or the money is lent or borrowed, and the accumulated balance minus principal gives you the interest. So these are the three simple formula which we need to remember. Now we go to page number 4.5 to solve number of numericals which have come in the exam and which are important from this particular part, that is simple interest. So we have noted till now what is the time value of money. We have discussed about why we have to pay interest when we take a loan, right? Third is we discussed about opportunity cost, liquidity, inflation, and then we saw that interest is basically when we pay interest or when we receive interest. Interest is of two types. We have simple interest and compound interest. We are now focusing on simple interest, and when we talk of simple interest, we have three concepts. First is the principal, the money which is taken on loan or given on loan, I, which is the interest rate, and T, which is the time for which the money is borrowed or the money is given as loan, right? So therefore, we are dealing with principal, interest, time, and then we saw that accumulated balance is equal to the principal plus the interest which is earned on the principal during that particular time. Now let us look at page 4.5. This is 4.5 of your study material. We are doing example number 1. Let us start with the simplest example so that we can build up our concept and we can get the confidence. How much interest? Please see the question. How much interest will be earned on rupees 2,000 at 6% simple interest for 2 years? Okay, we start with a very simple example. This is like, the numericals which we did long back in school. From there, we will slowly take more difficult questions, more challenging questions, so that we can build up our concept and we can deal with any questions which can come in the foundation exam. Right. So here you see the principal amount is 2,000 rupees. Right. So I can write this is P, principal. Interest rate I equal to 6% or 6% means 0.06. 0.06. Because 6% means 6 by 100, which is 0.06. Right? And the time is 2 years. So time equal to 2. So we have principal 2,000 rupees. Interest rate is 6%, which is 0.06. And now we have the time is 2 years. Okay. So we have to find what is the interest which we are going to earn. So interest is equal to principal multiplied by interest rate into time. Okay. So P into I into T. So here the principal is 2,000. So I will write 2,000 multiplied by the interest rate, which is 0.06, multiplied by the time, which is 2. Okay. So on 2,000 rupees at 6% interest for 2 years, how much am I going to earn? It is 240. Okay. So 2000 into 0.06 into 2 gives you 240. So this is the first example. I hope this is clear. We are dealing with three numbers, three elements you can say, principal, interest and time. We have seen the principal here. We have seen the interest rate 6% and we have considered the time of 2 years. Now we proceed to the next example. So let's go to page 4.4. Let's go to 4.4. Okay. Example is there, page 4.4. Okay. We'll do a different example now and we will look at a different case, of course. So example 2. example 2. Okay, please work out with me, and these are simple problems. As like the other days, let us work together the way you have coordinated and cooperated for the last few sessions with me. Please continue to do it. Have the pen and paper ready and let us work it out together. Of course, as I said, I'll be doing a small revisional session on matrices, on inequalities after today's session is over. So once we complete time value of money, I'll be doing that revision session, plus I'll be answering the questions which you have sent to me and we will try to discuss. Okay, now let us do this problem. Sania deposited, please see the problem. Sania deposited rupees 50,000 in a bank for 2 years, and the interest rate I was 5.5% per annum. Please note that the word per annum means per year, and it is the abbreviation, the short form is PA. So please keep a note of it. Many of you know, in case you are not aware, please note per annum means per year. So how much interest she will be earning? So Sania has kept rupees 50,000 in a bank for 2 years at 5.5%. How much interest she is going to earn? Friends, let me tell you here that why we are doing so many, numericals on time value of money. Why is it that 3 days, just imagine 3 sessions have been kindly given by Board of Studies to cover this chapter. 1 chapter, 3 sessions. Why? Because of its importance. Why? Not just as a chapter in mathematics paper, but because this chapter will give you the foundation for economics, for financial management, and later on when you start studying audit paper, when you actually go to a bank and do a bank audit during your articleship, you will find that these calculations, knowledge of these formula will be very useful for you in order to do the bank audit. So this chapter is a foundation for economics, for financial management, for risk management, for banking, and also for audit. That is why 3 sessions have been devoted only for this particular chapter. Okay, so in this example, let us work out what will be the interest. So, dear friends, interest we know is equal to principal P multiplied by I, that is the interest rate, multiplied by T, which is the time. So, in this case, if you see, the principal is 50,000, this 50,000 into the interest rate. 5.5% is the interest rate. Now, if 5.5% is the interest rate, what will be the decimal equivalent? 5.5. So, 5.5 will be equal to 0.055. Okay? So, 0.055. Right. So, we write 50,000 into 0.055. Because it is 5.5%. But this is per annum. And we have got 2 years. The money is invested for 2 years. So into 2. So time is 2. Right? So if you work it out, 50,000 into 0.055 into 2, it comes to 5,500. Okay? So the interest which she will be earning in 2 years time, after 2 years, is 5,500, and after 2 years, the accumulated balance which she will be having is how much? 50,000 plus 5,500, which is 55,500. This will be the accumulated balance or the amount which she will be having after 2 years. So this is the concept of interest. Now we move on to page 4.5, example number 3. Let's go on to page 4.5. Okay. Right. Now, again a different question. Please do with me and let us clarify our understanding of the first part of this important chapter on time value of money. So, you can see this chapter is starting. The first part is quite easy. If you understand simple interest, you will easily understand compound interest. And if you see like a staircase, right, you go up. So simple interest here. If you understand this, you will understand compound interest also. If you understand compound interest, you will understand annuity and from their present value. So it goes like this, right? It goes up. So this is the foundation. First step. If you take the first step, you can go to the respective steps. You will not have any problem in this chapter. Okay. So let us do the third example. Sachin deposited 1 lakh rupees in his bank for 2 years. So principal is 1 lakh. The time is 2 years. Okay. So the money is invested for 2 years, and if you see the principal amount is 1 lakh rupees and the interest rate I equal to 6%. So how much will he earn and what will be the final value? So two questions, two parts to it. First is how much is his interest, and number two is what will be the FV, that is the final value. Okay. Now final value means what? Final value means the accumulated value, the accumulated balance, which means it is the sum of the principal amount and the interest amount. Right? Okay. So let us work on this. The same formula we are using again. So interest we have to calculate. We know interest is equal to principal into interest rate into time. Here the principal is 1 lakh. So it is 1 lakh multiplied by the interest rate. Interest rate is 6%. So we can understand 6% means 0.06. So these you should be practicing so that you don't make a mistake. 6% means 0.06. 0.06 into 2 years. So this gives me how much? This gives me, if you multiply, this gives me 12,000. So I earn 12,000 rupees as interest. For Sachin has invested this money, 1 lakh rupees for 2 years at the rate of 6%. So his total interest which he earns in 2 years is 12,000, number one. And number two, his final value is how much? His final value is principal plus interest. Because we know that AB, accumulated balance, is equal to principal plus interest. The principal amount with which you started and the interest which you are earning on the principal amount, if you put together, you get the accumulated balance. So in this case, he started with 1 lakh rupees, the principal amount is 1 lakh and he has earned 12,000. So the total final value is 1 lakh plus 12,000, that is rupees 1,12,000. Okay? As simple as that. It is so simple. Right. Now we move on to the next example. Page 4.5 we continue. Okay. So please do this. Numericals are very small. So please do it with me. And as and when we complete each and every numerical, you will find that your confidence level also goes up and you will start having grip on this particular chapter. Now we go to the next question. Find the rate of interest if the amount owed after 6 months is 1050 and the borrowed amount is 1000. It is there in the study material, page 4.5. Now here, the borrowed amount is 1000. Okay? The borrowed amount is 1000 and the time period T is 6 months. Okay, and the amount which is accumulated after 6 months is 1050. So the accumulated balance is 1050. Okay. Now here we know that accumulated balance AB, say AB, is equal to principal plus interest. Right. Now we know this borrowed amount, but we don't know the rate of interest. Okay, right? So let the rate of interest is I percent. Okay, let's call it I percent. So You know the accumulated balance, this is 1050. So 1050. You know the principal. Principal is amount is the borrowed amount, which is 1000 rupees. So you write 1000 plus interest. Now we know interest is equal to how much? Interest formula is I equal to principal multiplied by interest rate into time. Okay? So the principal we know is 1000. Interest we have taken I, and time is equal to 6 months. Now please note 6 months means how much? Half year. So it is 6 months means half of a year. So we will write half year into half. Right. So what do we get? We get principal is here. Interest we put this 1000 I by 2. So if you subtract, what do we get? 1000 I by 2 gives you 1050 minus 1000, that is 50. In other words, 1000 into I gives you cross multiplying. We are cross multiplying. So you get 50 into 2, which is 100. So 1000 I is equal to 100. 1000 into I gives you 100. So the rate of interest I is equal to 10. Because I is equal to 100 by 1000, which is 1 by 10. And 1 by 10 means 10%. Right? So this is how we are doing it. In this problem, we have to find the interest rate, the principal amount is given, the time period is given, the accumulated balance is given, and here the time period is 6 months, which means half of a year. So by using the formula, we are able to derive the solution, and the solution is that the interest rate is 10%. Right? Now we move on to the next example. So we are doing number of examples to build up our concept. I think this is clear to you. In the first 2-3 examples, we worked on calculation of interest. Now in this example, we have worked on the calculation of the interest rate. And the interest rate you saw was 10% in this example. Right. Now let us go into another example. In this example, we have to find out the time during which the money was invested. Right? As I told you, there are 3 variables, 3 parameters, 3 parts to these questions. First is principal, second is interest, and the third is time. And interest means it is nothing but the interest rate multiplied by the time period and the principal amount. Okay, so let us see this example now. So this is example number 5. Okay, and this is page number 4.5, right, of the study material. So we are strictly following the CA Foundation curriculum for this chapter, and we are strictly following the study material. Now, the question is, please open the question. Rahul invested 70,000 rupees in a bank. So the principal is 70,000. Invested 70,000 in a bank at the rate of 6.5% per annum. Right? So the interest is equal to 6.5% per annum, which means, what is the decimal equivalent? 0.065. Right? And he received an amount, that is an accumulated balance of 85,925 after the end of the period. Now we have to find out what is the length of the period. That means here time we do not know. We have to find out the time. We are given the principal amount, we are given the interest rate, and we are given the amount, that is the accumulated balance. Right? Now friends, we know that interest is equal to, first I'll write this way. Let me write it in the simplest way, which we can easily recognize. We know that accumulated balance is equal to principal plus interest. Right? Accumulated balance equal to principal plus interest. So, interest is equal to accumulated balance minus principal. We can write In this case, please see, interest will be equal to accumulated balance minus principal. Accumulated balance is 85,925 minus 70,000. Principal is 70,000. Okay? So you have the accumulated balance minus the principal amount gives you the interest. How much is this? This comes to 15,925. Now we also know interest is equal to what? We know that interest is equal to principal into interest rate into time. P-I-T, small I. P is the principal, I is the interest rate, and T is the time. So we know that the total interest received is always equal to the principal amount into the interest rate into the time. Right? And here principal we know is 70,000. Interest rate we know is 6.5, that is 0.065. But we don't know the time. So T is unknown. It is like equation, one unknown, simple equation, linear equation with one unknown. As simple as that. So this is what we do here, and therefore the equation which we bring is this I will be equal to 70,000 into 0.065 into T, and this is equal to 15,925. Okay? This is the left hand side, this is the right hand side. If you simplify, you can just work it out. I'm not going into the calculation. You have a calculator in hand. Please work it out. It will be a good practice also for the exam of how to use the calculator fast. If you do it, you will find that the time in this case, time will be equal to 3.5 years. If you simplify this part, you will get T equal to 3.5. That means the money has been invested for 3.5 years, that is 3.5 years, at the rate of 6.5% per annum, and at the beginning of the period, the principal was 70,000 rupees, and at the end of the period, the amount or the accumulated balance has become 85,925. Okay. Now we proceed to example 6. Okay. Right. I am rubbing this. I hope this is clear to you. So, in one problem, we were asked to find out the interest. In one problem, we were asked to find out the time. And here again, we saw it is a question of time. You have to find out what is the time period for which the money was invested. Now we proceed to example 6. This is page 4.6 of your study material. So let us do all the problems, most of the problems in the study material. And this is 4.6, example 6. So it is example number 6, page 4.6 of the study material. The question is a sum of money, a sum of rupees 46,875 was lent out at a simple interest rate, and at the end of 1 year, 8 months, the total amount was 50,000. So the total amount was 50,000. We have to find out the interest rate. We don't know the interest rate. Okay. Now, please see that the principal amount here, the principal, this 46,875 is the principal. The money which was lent out or which was given as a loan. The money which was invested, 46,875. The amount after interest is added, it becomes amount AB, accumulated balance or amount is 50,000. And we know that the time is 1 year, 8 months. Now 1 year, 8 months means 1 year, 8 by 12. Because you know there are 12 months in a year. So it is 1 year, 8 by 12. So it is 1 year, 2 by 3. So it is 5 by 3 years. Okay. So we can see that it is 5 by 3 years, and we can see the principal amount. We know the accumulated balance also. The formula you know is A equal to P plus interest. Now interest is again, basically we can write in this way that it is P plus P into I into T. Because principal amount is there, this principal amount, interest is the principal amount multiplied by the interest rate into T. So, very simple, you take P common from here, it is, if you take P common here from here, you get 1 plus I into T. This is the formula, right? Now here we know amount is 50,000, right? So on the left hand side we write 50,000. Principal amount is 46,875, right? So we write 46,875 multiplied by 1 plus IT. 1 plus I we don't know, so I we keep as I, but T is 5 by 3. So this comes here. So I into 5 by 3. Right. So if you simplify this, it becomes 1 plus 5 by 3I is equal to 50,000 divided by 46,875. Now if you further simplify this using a calculator, probably you will find that the interest rate I comes to 0.04, which means it is 4%. 4%. Okay, so this is how we solve these type of problems using the simple equation. Amount is equal to principal plus interest, which is principal plus principal into interest rate into time. So by taking principal common, P common, you get P into 1 plus IT, right? So this is example number 6, and this was from page 4.6 of your study material. Now friends, we are proceeding to the next example. I hope these are understandable, you are able to follow, you are able to practice with me, and definitely it's a very simple equation with which we are dealing with 3 factors: principal, interest and time, and the numericals are very easy in nature, direct application, and we are able to solve these problems. Now we proceed to page number 4.8. So I'll go to page number 4.8 and now we are going to do our example number 7. So already we have done 6 examples. I hope you are finding it easy, and I can understand you already probably had an accounts class earlier. So it's a Saturday afternoon. You may get a little tired, but then I request you to please focus yourself, and please never forget that CA also means not just chartered accountant, but CA also stands for continuous action, right? So please be active and let's continue. So I move to page number 4.8 and this is example number 7. Okay, example number 7. Let us note the problem. Please open the example and let us note the problem. The question is, in what time the amount is given. Please note that the amount is given. Okay. In what time 85,000 rupees, the principal amount is 85,000 rupees will become 1,57,675 rupees at the rate of 4.5% per annum. Okay. So the question is, 85,000 rupees is the principal amount and it will become 1,57,675 rupees after a certain period of time, after certain number of years. We have to find what is the duration, the number of years, and we are given the interest rate 4.5% simple interest. Now friends, we know the formula once again, that the basic formula, amount is equal to P into 1 plus IT, right? So you know this stands for amount or accumulated balance. P is for principal, I is the interest rate, and T is the time. Here we don't know the time. So time is a question mark, right? But we know the amount. So the amount is this. Okay? So this goes to the left hand side. 1,57,675 is equal to P. P is principal, 85,000. So 85,000 multiplied by 1 plus IT. 1 plus I into T. Now I is given. Please note that I is given 4.5%. Okay, I is 4.5%, which means it is equal to 0.045. So I write here I into T. T we don't know. T is a question mark. So I write 0.045 T, which it's a equation. You can see one unknown. It is a linear equation because T is having T to the power 1. So the index number is 1. So therefore it is a linear equation. And last day I was discussing how to graphically draw linear equations. You may remember that. So here, if you just transpose from this side to this side, it becomes 1 plus 0.045 T. Okay, this is equal to 1,57,675 divided by 85,000. Right? Therefore, 0.045 T is equal to 157,675 by 85,000 minus 1. This one comes to the right hand side and becomes negative, minus 1. Okay? So from here, if you solve for T, T will come to 19 years. Right? If you solve it with the calculator, it will come to 19 years. And therefore, the time is 19 years. After 19 years, this 85,000 will become 1,57,675 if you apply an interest rate of 4.5% per annum. Okay, so with this, dear friends, we complete the simple interest portion, and now we go to a more interesting area, and that is compound interest, right? So compound interest, very interesting point, compound interest. Compound. Okay. So what is compound interest? Simple interest means I am putting 1,000 rupees in a bank, right? The interest rate is say 7%, right? 1,000 rupees, 7% interest. I am putting it in a bank. So principal is 1,000. Interest rate is 7%. Time is 1 year. So I earn how much? P into I into T, that is 1,000 into 7% into 1, that is 70 rupees. This is my interest. Fine. But just imagine, let's take an example of how we can understand compound interest. This is simple interest, and we have done 7-8 numericals based on simple interest. Now I am taking the example of compound interest. Compound interest means interest on interest. Okay, compounding. Now friends, you might be knowing that there are some investments like Public Provident Fund, PPF, Public Provident Fund. There are some small post office investments like National Savings Certificate, NSC. Okay, you have National Savings Scheme, NSS. Right? You have certain schemes where if you put money, you will earn interest but at compound rate, compound interest. That means, let us take an example. I have got 1,000 rupees. I put it in a bank at 10%. At the end of first year, how much will I earn? Rate is 10%. The principal is 1,000. Time is 1 year. Okay? So how much will I earn? So let us draw columns. Principal amount. This is the first column P. This is the interest amount, this is the time. So I have got 1000 rupees, interest rate is 10%, 1 year. So how much do I earn? Interest, and what is my accumulated balance? Okay, like in Excel, you have Excel, you are learning about Excel, so Excel sheet. Okay, so let us work out and see what becomes our number. What happens to these numbers? Right. So we have 1000 rupees starting, 10% is the interest, right? 1 year. So at the end of 1 year, what is the interest I will earn? It is 10% into 1 into 1000, that is 100 rupees. So my accumulated balance at the end of 1 year becomes 1000 plus 100, that is 1100. Please note, I had 1000 rupees, I earned 100 rupees as interest, 1000 rupees, I earned 100 rupees as interest. So my amount or my accumulated balance at the end of 1 year becomes 1100. Fine. Please note, now this 1100 becomes my principal for the second year. So this is first year, this is second year. Let us do it for fourth year, till fourth year. Okay. So this 1100 now becomes my principal for the second year. So it comes here. Right? So I write 1100 here, 1100. Interest rate is 10%. Again for 1 year. So I calculate 1100 is my principal now, 10% for 1 year. So 1100 into 10%, that is 1 by 10 into 1. So I am earning 110 rupees. So I am earning 110 rupees as interest. Please note, 110 rupees as interest. Okay. This 110 rupees again gets added to my principal because I want to find out this column, that is accumulated balance, right? And we know that accumulated balance is principal plus interest. Principal is 1100 and my interest is 110. So my accumulated balance becomes 1210. This 1210 becomes my principal for third year. I earn 10% again on this amount for 1 year. So the calculation is 1210 into 10% into 1 year. So I earn 121 rupees. Okay. This 121 gets added to my principal because I want to find out my accumulated balance. Okay. So therefore 121, 1210 plus 121. So 1210 is my principal. Before at the beginning of the third year, I am adding 121 I am adding, which is my interest I earned. So my accumulated balance becomes 1331. Okay. So at the end of 3 years, my accumulated balance becomes 1331. This 1331 now becomes my principal for the fourth year because this money, the interest is getting added to the principal. Next year again, the interest is calculated both on the principal and the interest. That is why we say that compound interest means interest on interest. Right? You can see that 1000 rupees we had, 10% is the interest rate for 1 year. We earned 100 rupees. So the accumulated balance became 1000 plus 100, that is 1100. This 1100 becomes the principal for the next year. Again, 10% we are assuming as interest. 1 year you get 110 rupees. And this 110 rupees gets added with the principal so that you get the accumulated balance of 1210 and the interest 10% is calculated on this 1210, which means this 1210 means what? It has a principal plus interest. So ultimately we are calculating interest on interest. This is the positive side of compounding. So if you invest your money in a bank, in a recurring deposit, or in a provident fund, public provident fund, you will see that the government pays interest on a compounded basis. It is not paid on a simple interest basis. It is paid on a compound interest basis. That is why most of our common man, especially the senior citizens, they always put their money in public provident fund, in different recurring deposit, so that they can earn interest on compounded basis and not on simple interest basis. So you can see the money you earn on compounded interest basis is always more than the money which you will earn on a simple interest basis. So in the fourth year, you have 1,331. Again, you have 10% interest rate, 1 year. So 10% for 1 year on 1,331, your interest comes to 133.1. So your accumulated balance becomes 1,331 plus 133.1. So it is 1464.1. So you can see this is how the compounding takes place. Okay, so we are first looking at numbers. Now we will see the formula. Once you remember the formula, rest is easy. You can solve any problem which is going to be given in the exam. I am more than confident that you will be able to solve any problems. Right? So you can see here, in this case, interest is added to the principal. It becomes the accumulated balance at the end of the year, and this accumulated balance becomes the principal for the second year. Okay, so this is the concept of compound interest, which means interest on interest. Now let us see a small formula, right? So we could see how the compound interest operates. That's why I had to prepare this table format to make you understand how the interest is compounded, right? Now let us see the formula. Very simple formula. Accumulated balance we know is P into 1 plus I T. Okay. So you can write in this way that the amount is equal to basically principal into 1 plus interest, because this is P plus PI. Okay, principal into 1 plus interest. Now, at the end of 1 year, let us take in this way, I have 1,000 rupees. Interest rate is 10%. Okay, so how much do I get at the end of 1 year? I get 1,000 into 1 plus I. 1 year, at the end of 1 year. So I get 1,000 into 1 plus 0.1. 10% means 0.1. And this gives me how much? 1,000 into 1.1, that is 1,100. So the formula is P into 1 plus I. This is for first year. But now in compounding what happens? Right. In the second year, this 1,100 becomes my principal. I will be calculating interest on 1,100 in the second year and not on 1,000. So this will come to me as my principal. Again, I will use the same formula, 1,100 into 1 plus I. So it is 1,100 into 1 plus 0.1, whatever it comes to. So in this way, if you go on, you will easily understand that the formula is nothing but, in case of compound interest, the formula is the total amount of the accumulated balance will be P into 1 plus I to the power n. P into 1 plus I to the power n. Okay? And here n is nothing but the number of years. I is the interest. Okay? So the interest rate you know, like we have written 0.1 here because it is 10%. So you know the interest rate, you know the principal, and if it is 2 years, n will become 2. If it is 3 years, it will become 3, and so on. So you can find out, this is the formula, please note, for compound interest. Sometimes the short form in the problem, if you see the problems in the exercises in the additional question bank, you will see that the term CI is written, which means compound interest. Okay. So the formula, please remember, is A equal to P into 1 plus I to the power n, where n stands for the number of years. In other words, it is the total number of conversion which takes place. We will explain that through more examples. Okay. Now, you can see that I will write both the formula here once again so that you can keep a note of it. And we will also see the difference between simple interest and compound interest. So, if I draw a table like this, in case of simple interest and in case of compound, basically there are 2 or 3 differences. The first, in case of simple interest, the principal amount is constant. The principal is constant. Every year, if I keep money, say at 5% simple interest, and the money I have kept is 1,000 rupees. So every year I am going to earn 5% of 1,000. The principal will remain 1,000. First year I will earn how much? 5% of 1,000. That is how much? 50 rupees. Second year also I will earn 50 rupees. Third year also I will earn 50 rupees. Why? Because the principal remains the same at 1,000 rupees. But in case of compound interest, what will happen? Let us draw the table. Okay. So, we are taking, let me draw one table here. We are taking 1,000 rupees. Interest rate is 10%. Here we are drawing year 1, 2, 3, 4, 5. Till 5th year we will go. Okay. So, first year, okay. So, first year, second year, third year, fourth year, 5th year. Right. First year, year 1. Okay. So, year 1. 1,000 rupees. This is simple interest, and here we are doing compound interest. Left hand column is simple interest column. So, we are going to calculate the earnings, the interest we are going to earn on the basis of simple interest, and on the right hand side we will compute the interest which we shall be earning over on a compound interest basis. Right. So, simple interest, 1,000 rupees, 10%. First year, 1,000 into 10, so 100 rupees. Second year, 100 rupees. Third year, 100 rupees. Fourth year, 100 rupees. Fifth year, 100 rupees. So, at the end of 5 years, the total interest which I have earned, total interest which I have earned is 500. Okay. And my accumulated balance, AB, that is A, it becomes how much? 1,000 plus 500, that is 1,500. I hope this is clear. 1,500. Right? Let us do the calculation on compound interest now. We have taken 10% interest, but on compounding basis. So, first year we had 1,000 rupees, 10%, the interest is 100. But now this interest, because it is compound interest, this 100 gets added to the principal. So, in the second year the principal becomes 1,100. Right? Under simple interest, once again I am repeating, under simple interest, the principal for all the years is constant, 1,000. Okay. But for compound interest, the principal will change. So, I will write here it will change. Why? Because now 1,100 becomes the principal for the second year, and 1,100 is my amount of principal. In the second year, I will earn interest at the rate of 10% on 1,100. So, I will be earning 110. This 110 will get added with this principal, 1,100. So, my third year principal becomes 1,210. On 1,210, again I will earn 10%. So, I will earn 121 rupees. This 121 rupees gets added again, 121. So, in my fourth year, my principal becomes 1,331. 1,331 I will earn again 10%. So, I will get 133 rupees approximately. I'm rounding up, 133 rupees. 133 gets added again. So I get 3 plus 1, 4, 3 plus 3, 6, 3 plus 1, 4, 1464. And in the 5th year, 1464 is my principal. I earn 10%, approximately I earn 147. Please see the interest column. Simple interest, first year 100. Compound interest, first year is 100. Same, no change. Okay, first year, no change. But from second year, under simple interest, 100 rupees. Under compound interest, 110. Third year, simple interest, 100 rupees. Compound interest, 121. Fourth year, simple interest, 100 rupees. Compound interest, 133. Fifth year, simple interest, 100 rupees. Compound interest, 147. So you can see, compound interest is good. If you keep your money in a bank, if you keep your money in some government scheme, if you keep your money in any type of investment, and if you earn compound interest, it is beneficial. So we can write, in case of compound interest, the interest earned is more. Interest earning is more. But in case of simple interest, it is less. Comparatively, it is less. So if you add up this side, 100 plus 110 gives you 210. 210 and 121. It gives you 331. 331 plus 133. 331 plus 133. 464 plus 147. 11, 4, 5, 611. Just imagine, in 5 years, over a period of 5 years, if you take simple interest, right? If you take simple interest, you are earning 500 rupees as interest. But if you consider compound interest, you are earning 611 rupees as interest under compound interest basis. So, you are earning 611, which means the extra which you earn, extra is 611 minus 500, that is 111 rupees. So you can see under compound interest, the earning is more, and please remember the basic difference is, in case of simple interest, the principal remains unchanged. The principal remains constant. But in case of compound interest, the principal changes and the interest also changes. But in case of simple interest, the interest remains the same. Okay, and you can see that in case of compound interest, I think this is visible clearly. In case of compound interest, the interest amount increases every year. So it's an upward graph. Okay, that is why compound interest is always favorable. Every investor wants to earn at compound interest basis, because you get more money by keeping the money for the same time. 5% simple interest versus 5% compound interest will give you a big difference. You will earn much more if you keep your money in compound interest, because you are earning interest over interest, interest on interest. Right? I hope this is clear. Now let us take a simple example and we look at numerical solution. So I am rubbing this part. Up till now we have discussed in details about how compound interest works. What is the formula for compound interest? You know that the formula is P into 1 plus I to the power n, where n denotes the number of conversion periods or the number of years. We will see n more closely when we go to the numericals. And you have seen that in case of simple interest, the principal and the interest payment remains the same year after year. It's a very similar, example. Since you are learning accounts, let me talk about depreciation, right? Now in depreciation, dear friends, you may have heard, you may have studied that ICAI has a standard, accounting standard 6 on depreciation. Now it is combined with accounting standard 10. Now depreciation talks about two methods. You have straight line method, you have reducing balance method. The reducing balance method is also known as WDV, written down value method. In that case also, the same difference. Straight line method means same amount every year. depreciation is constant, does not change, like simple interest, does not change. Okay, but in case of written down value method, it will change from year to year, very similar to compound interest. So please keep this thing in mind, that in case of compound interest, the principal changes every year. So the interest calculation also changes year after year, but the investor, the person who has invested the money, has kept the money in a bank or in a financial institution, and if he is earning at the rate of compound interest, if he is earning on the basis of compound interest, he ends up earning much more. So compound interest is favorable. And we have also seen the formula P into 1 plus I to the power n. Now we shall see numericals and we will solve it together like we are doing. I will request you to please keep your pen and paper ready and let us work on the next problem. Okay, now we have a lady, Saina. Saina is depositing Saina is depositing 1 lakh rupees in a bank for 3 years. 3 years. Okay. And the interest rate is 7%, but it is no longer on simple interest, but it is on compound interest. So I am writing CI, right? CI, compound interest. CI is the short form of compound interest. And please remember that. I will now refer to it as CI, compound interest. Now you have to find out what is the interest which she will be earning annually and what will be the money she will get at the end of third year. That means what will be the interest per year and what will be the accumulated balance which she will earn after 3 years. Okay, the problem is in front of you. You have 1 lakh rupees, 3 years, 7%, but compound interest.
Sir, good afternoon,
Yes, sir. Good afternoon, sir.
My question is actually compound interest equal to amount minus principal.
Yeah, amount minus principal, yes.
Yes. Here amount is P into 1 plus I whole to the power of n minus P. Am I right,
Yes,
sir?
minus P, yes, absolutely. Yes, I will use that formula. Yes.
Yes.
Right. Okay. So if you see, when we consider the compound interest in this example, first year again we know that we have got 1 lakh rupees. Right. So year 1 let us do, then we will do year 2 and we will do year 3. Right. Now if you see year 1, interest rate is 7%, but it is compounded annually. So the first year interest will be calculated on 1 lakh rupees. So 1 lakh rupees into 7%. We know P into I into T. Here T is 1 because it is for 1 year. Interest rate is 7%, which means 0.07. And the amount is, the principal is 1 lakh. Right. So your interest will be 7,000. Because it is 1 lakh into 0.07 into 1. But now this 7,000 gets added with the original principal of 1 lakh. So now the revised principal becomes 1,07,000. Okay, and now in the second year we are calculating the interest on 1,07,000. If you just calculate, you have a calculator in hand, you will find that it is 1,07,000 into 0.07. Interest rate is 7%, time is 1 year. You will see that this amount will come to 7490. This is the interest which you earn in the second year. This now gets added with 1,07,000. So in the third year, your principal becomes 1,07,000 plus 7490, which is 90490, and this is 1,14,000. On this amount, 1,14,490 in the third year, 1,14,490 into 0.07, you are going to earn, the interest will be 8014.30. So the total interest which Saina is going to earn in these 3 years will be the sum of 7,000 plus 7490 plus 8014. If you add them, you are getting 22,504.30. This is the total interest she is earning, and since she started with 1 lakh rupees, 1 lakh rupees was the principal. So the amount is equal to principal plus interest, which is 1 lakh plus 22,504. That is 1,22,504.3. Okay, so this is a problem which is given in the study material of our ICAI, and this is the best way to understand, and we will move into more difficult numericals. So you can see up till now the basic difference between simple interest and compound interest is that in case of simple interest the principal remains the same, but in case of compound interest the principal is different, and in case of compound interest we have the formula amount is equal to principal into 1 plus interest to the power n. So from here you can understand interest we know is P plus I. Okay, so from here we can get the basic idea that interest will be equal to P into 1 plus I to the power n minus P. That gives you the interest part, right? So this is the formula for compound interest. Please remember that many of you, as I was explaining earlier, several investment schemes, since you will be studying about financial management, you already have business and commercial knowledge in your foundation. Now you know that there are certain investments like certain fixed deposits in banks where the interest is paid on compound basis. That is, you are going to earn interest on interest, plus certain investments like public provident fund and certain other post office saving schemes also have the concept of has the concept of this rolling forward, that is compound interest. Okay, now we are going into conversion periods. Let us see the type of conversion periods. Now you see there are many banks who have got the they will tell you that we will be compounding 2 times in a year. That means what? You start with 1,000 rupees. Let us see the example. Okay, you have started with 1,000 rupees and your interest is say 8%. 8% interest. Your initial principal is 1,000 rupees. Right. Now, say the bank tells you that they shall be compounding the interest semi-annually. Semi-annually means every 6 months. Every 6 months. So what will happen? I started with 1,000 rupees and I have a simple interest of 8% per annum. That means in 1 year I should be getting 1,000 into 8%, which is it's coming to 80 rupees. But since I am using it for 6 months, compounding will be done 6 months. So for the first 6 months, I will be getting 50% of 80, that is 40 rupees. So at the end of 6 months, my accumulated balance is principal plus interest, P plus I, which is 1,040, 1040. After 6 months, for the remaining 6 months of the year, now the interest, the bank will calculate interest on the basis of 1040. This 1040 and not on 1,000, not on 1,000, on 1040. This is called compounding every 6 months. Sometimes it is called semi-annual compounding. Semi-annual compounding means half of the year. That means after every 6 months, the interest which you have earned will be added to the principal, and for the remaining 6 months, the interest will be calculated on the revised principal part. Right? So, for the next 6 months, first 6 months we have got the interest, 40 rupees. Now for the remaining 6 months, 1040 becomes the principal. Now we will calculate the interest. So 1040 into 7%. We have assumed 8% into 8%. But this is for the year, full year. So divided by 2. So we are getting 1040 into 0.08 by 2. That is 0.04. So whatever this comes, 1040 into 0.04. So this is how the compounding is done semi-annually. In this way, there are different banks, you see, and this period of 6 months which you see is called the conversion period. Conversion period. Please keep a note of this. This is called conversion period, and you can have conversion period every 6 months. You can have conversion period every quarter. You know quarter means how many months? Quarter means 3 months. You have 4 quarters in a year. First quarter, second quarter, third quarter, fourth quarter. The first quarter is April to June because you know financial year starts from April. So if it is April 2019 to March 2020, first quarter means April, May, June. Second quarter means July, August, September 2019. Third quarter is October, November, December. And the fourth quarter is January, February and March this year 2020. So a financial year is divided into 4 quarters. So a bank, in the problem, in the numerical, you may also get a question where it is stated that the compounding is done 4 times in a year. That means every quarter. Here we saw compounding is done semi-annually 2 times. At the end of 6 months, again at the end of 1 year. It can be quarterly compounding, it can be 2 times, it can be 4 times also. Now, in the page number 4.11 of your study material, please see the chart which is given on page number 4.11 of the study material. You will see that they have given the compounding chart. So, page 4.11, the conversion period is given. So, it can be 1 day, it can be 1 month, it can be 3 months, it can be 6 months, it can be 12 months. When it is 1 day, we call it daily compounding. Okay, that means in a year, since there are 365 days, that means the number of conversion period, that is N, the number of conversion period is 365. Okay, of course you don't get daily compounding anymore because in that case if banks give interest at the end of 1 day and again they add it to your principal, then the banks will go out of business. They will have to pay a huge amount of interest. But for the sake of numericals, we need to know what is daily compounding. Similarly, if it is compounded every month, that means the interest which I am earning for 1 month is added to the principal. Next year, next month, the interest is calculated on the combined amount. So in that case, we call it monthly compounding. So it is monthly compounding and the conversion period will be in 1 year, there are 12 months. So conversion period, number of conversion period is 12. Of course, number of conversion period means number of conversion period in a year. 3 months. If it is given in the problem that the compounding is taking place every quarter or say for example, say they are saying that in every 3 months, right? So in that case it means it is a question of quarterly compounding. So quarterly compounding, which means the conversion period, number of conversion period will be how much? In 1 year you have 12 months, conversion is done 3 months, so 12 divided by 3, that is 4 conversion periods. You will get 4 conversion periods. In case of semi-annual compounding, yes, you will get semi-annual and the conversion period is 2 because every 6 months it is being done, and if it is yearly compounding then it is annual and number of conversion period is 1. So please remember this, it can be daily, it can be monthly, it can be quarterly, semi-annually or annually, and accordingly you have to be careful about the formula and what to write in the formula so that you don't make a mistake. Okay, now let us take 4.12, page number 4.12 of the study material. We will do some numericals and you will understand the formula better. Okay, so this is now we are moving to page number 4.12. So I am writing page 4.12 and this is of course example number 9 which we are doing. We have done 8 examples earlier. The question here is 2000 rupees is invested at the annual rate of rupees 2000 invested at the annual rate of 10% per annum. Now we have to find out what is the amount after 2 years. Okay, if the compounding is done annually. Okay, B, if the compounding is done semi-annually, semi-annual. C, if the compounding is done quarterly. And D, if the compounding is done on a monthly basis. So all 4 bases will be covered. 2,000 rupees and the amount, the interest rate is 10%. Right? Please keep a note of this. Principal amount is 2,000. The interest rate is 10%. It is a question on compound interest, and we have to find out that what will be the value, what is going to be the value after 2 years if it is done, if the compounding is done annually, if it is done semi-annually, that means every 6 months, if it is done quarterly, that is every, there are 4 quarters, so every 3 months, and if it is done monthly, every 12 months. Okay. Now please note that the formula we have seen is A is equal to P into 1 plus I to the power N. We have discussed this formula where A stands for the accumulated amount, P is the principal, I is the interest rate, and N is the number of conversion. Now, when we are doing the annual compounding, okay, we are going for the annual compounding. Let me take first, we'll take it as, okay, we'll take the annual compounding. Okay, annual compounding means it is compounded once every year. Okay, that means here the conversion, number of conversion period is 1, annual. So, you have the principal amount 2,000, 1 plus interest rate is 10%. Interest rate is given 10%. Please note 10% means 0.10. So, 1 plus 0.10 to the power N. Here N is 1 because the conversion period is 1. The number of conversion period is 1. So, the formula is 2000 into 1 plus 0.1. That means 2000 into 1.1. That is 2200. Okay. Now the question is, if this is, please note this is 10% and the conversion is done annually. Now what happens when we see that it becomes a question of, say for example, semi-annual compounding. Let us try the semi-annual compounding now. What happens if we do semi-annual compounding? Now please note this interest rate which is given, 10%. This is per annum. That is for 12 months. But if we have to do the semi-annual compounding means there will be 2 compounding, n equal to 2. Semi-annual means 6 months. So compounding at the end of 6 months, 1 again at the end of 6 months. So it is 2 times. Therefore, interest which is considered on a per annum basis, now for 6 months, it will become 10 by 2, that is 5%. So the interest, if you see, will become 5%. Okay. So please note, and this is an important part of your calculation, because when you are doing semi-annual compounding, when you are doing quarterly compounding, my request to you is please note and make the change in the interest component. Okay. Because here I and N will change. It is semi-annual compounding. Therefore, what we are going to do is very simple. We are going to consider in case of semi-annual compounding. Now, question is 2,000 rupees is kept for 2 years. Please note, we are considering now the example is for 2 years. Okay. 2 years and we are considering semi-annual compounding, which means in this case, if it is for 1 year, then N is 2. But if it is for 2 years, as in the example, then N becomes 4. Because 6 months, 6 months, 6 months, 6 months. Okay. Since we are considering for 2 years, if it is for 1 year, then N will be 2. But if it is for 2 years, N is 4. But compounding is done every 6 months. 10% interest is given for 1 year. So for 6 months, it is 10 by 2, that is 5%. So the formula becomes 2000 into 1 plus 0.05, because 5% means 0.05. So it is 0.05. This is the I. You know the formula is P into 1 plus I to the power N. I is 0.05. But now N is 4 because the numerical, in this numerical, for this calculation, it is considered to be 2 years. The money is kept for 2 years. The money is invested for 2 years. So 2 years means there are 4 cases of 4 conversion period, because the compounding is done every 6 months. 2 years means 24 months. And 6 months, 24 by 6 is 4. So the formula in this case is 2000 into 1 plus 0.05 to the power 4. If you calculate this, it will come to 2000 rupees into 1 plus 0.05 to the power 4. If you calculate, it will come to 1.2155. So the amount is 2431, 2431. So this is on the basis of 2 years, and when we are going for semi-annual compounding. If we go for annual compounding, same thing. Only thing is, in case of annual compounding, what will happen? 2000 rupees, 2 years, annual compounding. So amount will be 2000. Annual compounding, we know the interest is 10%, so 0.10. And in case of annual compounding, in 1 year, compounding is done once. In 2 years, compounding will be done twice. So 2000 into 1 plus 0.1 square, because n is equal to 2 here. So this will be 2000 into 1.21, because 1.1 square is 1.21. So you will be getting 2420 for 2 years. Compounding is done annually, duration is 2 years, amount is 2000. Now we proceed to the question for quarterly compounding. See, these are the types of problems which you will be getting in the exam, and I have taken this example so that we can understand everything about compounding and we become clear with the concept. The formula is simple. You have to be only careful. The formula is, you see, the formula is very simple. When you are calculating the amount, P into 1 plus I to the power n. My request is, be very careful with the n and with the I. If the interest rate is 12% for 1 year, and if the compounding is done every 6 months, that means for 6 months, the interest is not 12%. 12% per annum means 12% for 1 year. So for 6 months, the interest is how much? 12 divided by 2, that is 6%. So it will become 0.06. Please remember this. Okay. Similarly, n, for semi-annual compounding, n will become 2. For annual compounding, n is 1. Okay. However, in this case, since the period is 2 years, we are going for quarterly compounding now. So we have done annual, we have done semi-annual. Third one is quarterly. So what happens when there is a quarterly compounding? The formula, dear friends, remains the same. No change in the formula. Only the change will be in I and n. Right? So let us see what will be the amount which we will be getting after 2 years on the basis of quarterly compounding. Dear friends, kindly note that in case of quarterly compounding in 1 year, if you are considering 1 year, there are 4 quarters. So n is equal to 4. But here it is 2 years. The duration is 2 years. 2 years means n will be equal to 8. 4 into 2. 8 conversion periods will be there over a span of 2 years. Plus, please note that interest rate is given 10% per annum. Okay? And the compounding is done on what basis? On quarterly basis. Quarter means there are 4 quarters. So if the annual interest is 10%, the interest for 1 quarter is how much? 10 by 4. Because there are 4 quarters in a year. Annual interest rate is 10%. 4 quarters. So therefore the quarterly interest becomes 10 by 4. That is 2.5. So we have to write 2.5%. 2.5% means in the decimal form it becomes 0.025. Okay. So now what will be the formula? Formula is same. Only there will be difference in I and n. Right? So let us write. The amount after 2 years, A, right, will be equal to principal. You know the principal is 2000, so I write 2000 here. 1 plus I. 1 plus I is 0.025. So 0.025. To the power 8. Because we have seen n is equal to 8. Why? Because it is a case of quarterly compounding for 2 years. So the conversion period, the number of conversion period is 8. So if you just calculate it, you will find 2000 into 1.025 to the power 8, and this will give you 2000 into 1.2184, and the amount will be 2436.8. This is what we do in case of quarterly compounding. Now, dear friends, we go to the last one. We have done quarterly, we go to the last one, that is monthly, right? I hope you are able to follow and you are able to understand each and every solution. We are going step by step. First we saw what is simple interest, then we saw what is compound interest, then we saw the difference. I worked using two columns to show you the difference between simple interest and compound interest. When we take an amount of 1000 rupees, how the compound interest increases over a period of time. And we also analyzed together that in case of compound interest, the principal amount will change from year by year. And then we have seen the formula, and the formula all of you have seen and you have memorized, I am sure, that A is equal to P into 1 plus I to the power n, which means that interest will be equal to amount minus principal. That is, in this case, amount is this. So P into 1 plus I to the power n minus P. Okay, this is what we have discussed till now, and now we will do the monthly compounding. Okay. So what will happen in case of monthly compounding, dear friends? I leave it to you. Please apply your mind. Now, in case of yearly compounding, the annual interest rate is 10% for 1 year. 10% per annum. Okay. Now, 10% per annum. This time we have to focus on monthly. 10% per annum. It means 10% means 0.10. But this is for full year, 12 months. We are doing monthly compounding. So if I am getting 12% interest in 12 months, that is in 1 year, how much I will be earning per month? I am getting, say, 24 rupees throughout the 0.00833. Right. This is your interest. So I is done. I is done. Now we come to N. That is, N means, you know, the conversion periods, the number of conversion periods. Now, please note, this is monthly compounding. In 1 year, you have 12 months. But here we have 2 years. 2 years. So, N is equal to 24. That is 12 into 2. N becomes 24. So, the number of conversion periods becomes 24. N is 24. And what we get is I is 0.00833. Dear friends, if this is what we have, then let us put these numbers into the formula and see what is the value we are getting. So, the value will be P into 1 plus I to the power N. Here P is 2000. So, 2000. 1 plus I is 0.00833 to the power 24. This is a humongous calculation, but you know, shortcuts are there. I was discussing about certain shortcuts, how to use the shortcuts in calculation. Please remember, for the exams, once again, you are only allowed to use normal calculator, but scientific calculator is not allowed. Therefore, if you use the calculator, you will find that 1 plus 0. This expression actually becomes equal to 1.22029. So, the amount is 2000 into 1.22029. You are getting 2440.58. Okay. So, this is the amount which you are getting after compounding it on a monthly basis at the end of 2 years. Okay, now we are going for another problem. I will request you to take page number 4.13. So, I hope you are getting clear as we are progressing. We have to possibly go beyond 4 o'clock because it is already 4 o'clock, but we have to continue because we have a lot of things to do. After this, I will take this example, stop for today. so far as the time value of money is concerned, and we will go to the responses of the last day. And in case you don't have any query regarding the last day, if you want, you can stay with us, but I will continue with certain revision areas in matrix, determinants and linear inequalities. I thank the institute for giving us the extra time after 4 o'clock so that we can extend our discussion, and you can see that already we have utilized 2 hours to understand time value of money. We talked a lot about what is time value of money, why interest is paid and received, what is opportunity cost, how simple interest is calculated. We did number of numericals on simple interest. Then we proceeded to compound interest concept. We saw the difference between simple interest and compound interest. Then we saw different conversion period. 1 month, 3 months, that is quarterly, semi-annual, annual. And then we did numericals. Now I will request you to go to page number 4.13. This is the last example we are taking today for our discussion on time value of money. After this, we shall move on to determinants. Some other areas are there. I will also discuss and throw some more light on the areas like, say, adjoint matrix, inversion, when we talk of the adjoint matrix, cofactor of a matrix, inverse matrix, etc. And we will also do some more examples on linear inequalities, especially the graphical part. Right. So please let us concentrate together and continue with the next example. This is example 10. So we have completed 10 examples in time value of money. This is page number 4.13. You will see example 14 on page number 4.13. Now, the question, if you kindly open the question, you will find the question is, we have to find out the compound interest on rupees 4,000 for 1.5 years at the rate of 10% per annum. Compounded half yearly. So the compounding is half yearly. That is, in other words, we call it semi-annually, right? Semi-annually. This is the problem. So let us focus on the solution. Take it very in a calm manner, cool manner. This chapter will give you number of problems in the exam. If you are thorough with this chapter, dear friends, you will score very high marks. And once again, I am thankful to the institute and to the organizers of this excellent virtual coaching class to allot this chapter for me to get the opportunity to come and address to you and teach you about this chapter, because it is also one of my most favorite chapters, and time value of money is the basis. Next day when you see, we will discuss about the bond, right, leasing. You will be astonished, you will be surprised to see the wide application of this chapter, and that is why the chapter carries a weightage of 20 to 25% of the marks. And secondly, Institute of Chartered Accountants has kindly given us 3 sessions only on this chapter, which means this chapter is really important. We have to know simple interest. We have learned compound interest. We have to know compounding. We have to know what is annuity and so on. Right? So please go on coordinating with me. Let's work together on this example. You have 4,000 rupees. So principal is 4,000. Very good. Done. Interest is 10%. But it is for full year. So I equal to 10%, which means 0.10, but for full year. Please note here the compounding, I am underlining, it is half yearly. So if I am earning 10% in 1 year, how much I will earn in half year? That is 6 months. You are paying me, say I am earning 24,000 rupees per year as interest. 24,000 rupees in 1 year. So in half year, how much I will earn? 24,000 by 2, that is 12,000. So in this case, I am earning 10% in 1 year, that is 0.1. So in half year, I will earn how much? 0.10 by 2. Sorry, by 2. By 2, that is 0.05. I think this is clear. Sure, you are clear with this? Let's proceed. Now, the period is given 1.5 years. 1.5 years. And the compounding is done every half year. So, 1.5 years means how many months? 1 year is 12 months. So, 1.5 year is 12 plus 6, 18 months. 18 months. Done? The compounding is done every half year. Half year means 6 months. So, divided by 6. So, n is equal to 18 by 6, that is 3. That means the number of conversion periods is 3. We have got I, right, and we have got n. Now the rest is very simple. We just put it into the formula. So the question was how much we shall be earning as interest on 4,000 rupees. So first, let us find out the amount. The formula we are using is A equal to P into 1 plus I to the power n. Now, we have got all the values here. So the amount is principal 4,000 into 1 plus I. I is 0.05. So this 0.05 comes here, 0.05. N is 3. So N is 3. So 1.01 plus 0.05 to the power 3. 3 goes to the power. So if we calculate this, it will come to 4,630.5. Right? So how to calculate? 1.05 multiplied by 1.05 multiplied by 1.05. You will, and if you multiply it with 4,000, simple case, 4630. So this is the amount you are getting after 1.5 years. The question is how much interest I am earning. That means I had 4,000 rupees and now I have got 4,630.5. So how much have I earned? Just the difference of these two, 4,630.5 minus 4,000. So the interest I have earned is 630.5. I think it is clear, dear friends, because you can see here we have taken principal 4,000. Interest is 10%, but it is for the full year. We have to find out, since the question is clearly stating half yearly, so we have to divide 10% by 2. So we have got the interest 5%, right? Half yearly compounding, and the time period is 1.5 years, which is 18 months. So 18 divided by 6 gives me the number of conversion period. In this case, it is 3. So we have applied the formula P into 1 plus I to the power 3. And this is how we have got the amount, that is the accumulated balance. The accumulated balance minus the principal of 4,000 gives me the interest which I have earned on compound interest basis, and that works out to 630.5 rupees. Dear friends, with this, we are pausing our discussion on because already 4:15, we have to take up now the interesting case of matrices, and I will request you to stay and let us carry on with our discussion on the matrices part. And I will also talk a little bit about the responses, and we will see how best we can utilize the remaining time, whatever we can get, and let us continue. So here we are pausing with example 10. Next day we will carry on with time value of money from example 11 onwards, and we will go into annuity and we will discuss about other interesting areas. Now let me go back a little bit to the last 2-3 questions. Last 2-3 sessions we had. You see, the session on matrix, algebra and equations is vast. I have received 404 queries and feedback from you. Many of you are liking the classes and possibly you are comfortable with the way in which I am explaining. So thanks to you for that. I am going slow and I am trying to use maximum board work so that we can actually see the flow of the numerical, we can understand the different steps, and I am highlighting wherever possible and linking it with the study material so that you can coordinate, right? And number of questions have come. I am just calling out the names of some of my friends who have written. Srajal Gupta has requested me to take up scalar matrix. Once again, I'll do it. Om Gupta from, Srajal is from Kanpur. Thanks for writing to me. Om Gupta from Kolkata, example, he has talked about, requested me to take up Kramer's rule. I'll do that. That's why I'm using this time after 4 o'clock. First, we will focus on the topic of the day. Once we reach a comfortable position, then for the remaining part, that is the discussion related to your queries, right, the discussion related to additional examples, I am doing after 4, after the official time is over, and now we can use the balance time for this. Rahul, and this is the valuable time also to discuss about the queries and to acknowledge the name of those people who are writing. This will encourage you to come out with your queries and we can have a meaningful relationship as we proceed. Rahul Kumar Mishra from New Delhi has asked, sir, how many questions come from linear inequalities? Rahul, thanks for asking. At least 1 or 2 questions will come, definitely, looking at the trend of the past few years. Tejashri Badak and Anand Raj. Tejashri is from Aurangabad, Anand is from Patna. Sir, what is skew symmetry matrix? We will take up skew symmetry matrix and skew symmetry matrix after some time. B. Dhanush and Nazmeen Khan from Mumbai. B. Dhanush is from Andhra Pradesh and Nazmeen is from Mumbai. They have requested me to explain symmetric matrix and skew symmetric. I'll do it. Tanveer Ahmed Khan from Karimganj, Assam has requested to know, sir, is the paper complete MCQ? Yes. And is there negative mark? Yes, it is. I told you. Rohit Agarwal has from Jaipur has requested how to get study material online. Now I can only tell you that you can get it from website of the institute. I was already giving you the website ICAI.org. You can go into the website, look at the CA Foundation tab, and you can download the study materials. Any corrigendum, corrections to the study material, and you will get the MTP, that is a model test paper. Rehan from Karnataka has said, sir, these videos are recorded or available in YouTube. Yes, it is available even after the live session is over. Please don't hesitate to go through the videos. ICAI CA Tube. So it is the ICAI CA Tube channel. Please go through it. You will get the videos. Prakash from Chennai, sir, non-math student, how to score good marks in maths. My only suggestion, more practice, the way we are doing, hard work and time management. Isha Mohindru from Ludhiana, Punjab, will the virtual classes continue? She has asked, will the virtual classes continue even after the lockdown is completely lifted? I think this is a question you can ask directly to Board of Studies. They are the best people to answer your query. Utkarsh from Lucknow, sir, will BOS ICAI clear out the doubts when the session is over? Please clarify. I am trying to cover as many doubts as possible. Every day I am stretching beyond 4 o'clock so that we can discuss with so many queries, and unless I individually try to take the queries, there is no meaning. Generically, if I speak, no meaning. That's why I am creating an Excel sheet where I am noting down the name of the person, the location, specific query, I am answering that. Snehadhar Shini from Tamil Nadu asked a question, sir, is 2 hours enough to complete the full chapter? No, that's why we are crossing beyond 2 hours and continuing. Vijay Lakshmi M from Mysore, sir, whether scientific calculator is allowed in the exam? No, 12-digit normal calculator is involved, is allowed. Sai Harsha from Hyderabad has said, sir, your teaching is awesome, thanks to you for that. Atul Khatri from Rajasthan has said, is it necessary to attempt all questions in the paper? Yes. The more you attempt with greater accuracy, your score will go up, but be very cautious and be very confident before you attempt the question because there are negative marks. Savi Mangra from Gangtok, sir, what is the time period for these virtual classes, like from July, how many months? Request you to directly contact BOS if they can enlighten you. Hemant Singhal, New Delhi, sir, at the time of registration, he did not subscribe to the student journal, so how to get it? Please download the soft copy of the student journal every month. Very, very important for your exams as well as for your general development. Please download it from the institute site. Also, Anushka Gupta from Rai Bareli has said, she is from a maths background. What is new for me in CA Foundation? That is her question. I think matrix, revision of most of the chapters, plus Anushka, you are learning many chapters like time value of money, compounding, more from a commercial perspective, more from the perspective of a chartered accountant. Shrishti Pundalik Sutar from Pune, sir, transpose means row becomes column and vice versa. Yes, I will explain. Reshma from Raichur has asked, why maths is studied in CA? Is it important for CA? Very important for CA. Maths is the foundation, financial accounting, financial management, risk management, all the chapters which you will study in IPCC and final is based on mathematics. Naman Jain from Ashok Nagar has said that he has got no study material. Request you to download the study material online from ICAI.org. Dhruv Palwal from Vaishno Devi, Jammu. So from Ashok Nagar to Jammu. Sir, what is the difference between matrix and determinants? Determinants is a numerical way of expressing a matrix. We will do it. We have done determinants in details. Still, I will take your case. M. Chaturya from Anantapur. Sir, if we do not know the answer, which one is a better option? Whether to leave the question or to attempt by guessing? Well, I feel if you are guessing, if you are very confident about your guess. See, there are many ways of guessing. It can be a wild guess. It can be an informed guess. It can be a big risk. It can be a calculated risk. So it depends on how you take it. But I think if you are well prepared, try to attempt as many questions as possible. Sir, Sahil Raj has asked from Bihar, what is the difference between unit matrix and scalar matrix? Well, unit matrix is a type of scalar matrix where you know that all the numbers on the principal diagonal will be 1. Okay, next, Siddhant Khan from West Bengal. Sir, can you show submatrix with a 4x4 array? Yes, I will do today. Even though normally it does not come in the exam. Rohit Agarwal and Anshika Gupta. Sir, why we are learning matrix in CA Foundation? I gave you the answer. Once again, I am repeating. For portfolio management to understand risk and return on shares. G. Kartika from Sivakasi. Sir, what is equal matrix? Two matrices whose corresponding elements are the same and which has the same order. If it is 2x3, the other one also should be 2x3. And corresponding element should be same. Then it's an equal matrix. S. Sanjana Patra from Bhubaneswar. Sir, is this paper objective? Yes. Siddhartha Khajanchi from Bikaner. Can we say unit matrix is a part of scalar matrix? Yes, to some extent. Tarun Pupalla, Hyderabad. Sir, can you answer my queries? I request you to send a specific query. S. Hariram from Chennai. What is inverse matrix? We will see the inverse matrix. But first we have to know what is adjoint matrix. Then we will see that. Okay. And last few names, Susovon Fadikar has said that from Kolkata has said that, sir, you are working very hard to solve our problems. Thanks for your feedback. Yashvardhan Pancholi from Indore. Sir, please tell some calculator tricks. I have done it today in the first part of the session. Rishabh Mishra from Mathura. Please explain inverse and adjoint. I'll do it. Isabella from Tirunelveli has said, thank you, sir, for making these concepts easier to learn. Thank you. And Shreya Mukherjee from Ranchi has said that, are we going to learn inverse matrix? Yes, we are doing now. Okay. Also, I acknowledge Anshu Kumari from Bihar, Anurag Agarwal from Bulandshahr, and Mayurakshi Chaudhary from Assam for asking questions. I'll take up your queries. First, I'll quickly go to, the symmetric matrix and all. But first, I'll quickly take a small MTP question, and we have to stretch for some more time today. It is for your benefit. We are going beyond 4 o'clock, and I'm trying to add as much value as possible. This is a question which came in the MTP on equation. Right. Now, let me take this question. A seller is offering to sell certain articles that can be described by the equation x is equal to 25 minus 2y, where x is the price per unit. X is the price per unit and y is the number of units. Okay. And if the cost price is rupees 10, if the cost price is rupees 10, then what is the maximum quantity that can be offered in a single deal to avoid loss? This has come in the MTP, that is the model test paper, very important for your exams on equation chapter. A seller is selling certain items and it can be described by the equation this, where x is price and y is the number of units. Rupees 10 is the cost price, right? So the idea is, you have seen that x is what? The price per unit. X is the price. And you know 10 is the cost price. 10 is given as the cost price. That means if you just add, idea is what is the maximum quantity that can be offered without incurring a loss. Okay. So you can see that in this case, the price per unit is 25 minus 2y. So 25 minus 2y is equal to 10, which means 2y equal to 25 minus 10, that is 15. So y is equal to 15 by 2, that is 7.5. That means 7.5 units, right? If you sell, then it is a no profit, no loss situation. So the maximum quantity that can be sold to avoid a loss, the options are given 6, 7, 8 and 9. Right, so the maximum unit you can sell is 7 because the answer is 7.5. So if you sell 8 units, then there will be a loss because 7.5 is between 7 and 8. So the maximum whole number you can sell is 7. If you sell 8 units, then you will incur a loss. Okay, so this one is an important question which came in the MTP. Now let us go into the matrices. Okay, now I will take quickly some observations. Equal matrix. Some of the friends today asked what is equal matrix. I will take an example. So let us take A is equal to 1, 2, 3, 4 and 5, 6. Okay, this is A. So you can see there are 3 rows and 2 columns. It is a 3 by 2 matrix, right? And B is given, say it is 1, 2, 3, 4, 5, 6. Okay, 1, 2, 3, 4, 5, 6. Here we have 2 rows and 3 columns. So it is a 2 by 3. Is A equal to B? Can we say? No. Because even though the elements are same, but the configuration is not same. 2 cell phones having different configuration, not equal. This is 3 by 2 matrix. This is 2 by 3, not equal. Okay. Next one, let's go to what is symmetric matrix. Okay, now symmetric. So I am completing important parts. After the scheduled time is over, we have devoted full 2 hours 15 minutes on today's topic on time value of money. Now the extra time we are utilizing symmetric matrix. Many of you asked symmetric matrix. Symmetric matrix is a square matrix. Please remember it's a square matrix which is equal to the transpose, right? So if the matrix is denoted by A, then A will be a symmetric matrix if A is equal to AT, transpose. We already discussed what is transpose. I am taking an example. Let A is equal to, matrix A is equal to 1, 7, 3, 7, 4, minus 5, 3, minus 5, 6. Okay. So this is the matrix 1, 7, 3, 7, 4, minus 5, 3, minus 5, 6. If you find the transpose, let us find the transpose matrix. So AT, transpose matrix. So it will be 1, this 7 will come here, this 3 will come here, this 7 goes here, 7, this 3 goes here, 3, 4 remains as it is, 4, this 5 goes here, minus 5, this 5 comes here, minus 5, 6 remains as it is. So the matrix, transpose matrix is 1, 7, 3, 1, 7, 3, 7, 4, minus 5, 7, 4, minus 5, and 3, minus 5, 6, 3, minus 5, 6. So what do we get? Here we find that A is equal to A transpose. So it is a symmetric matrix. Symmetric. Both the sides are same. Think of a butterfly. Symmetric. You know symmetric objects, right? So a square is a square matrix. Please note that symmetric matrix, we are only referring to square matrix, that means 3 by 3, 4 by 4. But it does not apply to rectangular matrix. Okay, now we go to skew symmetry matrix. Skew symmetric matrix. Okay, skew symmetric matrix. This is what? Symmetric matrix we saw is a matrix which is equal to its transpose. Symmetric matrix is a matrix which is the same as its transpose. But if there is a situation where the transpose of a matrix is equal to negative of the matrix, AT equal to minus A, then it is called skew symmetric matrix. Let us take an example. Let A equal to 0, 2, 0, 2, minus 4, 5. 0, 2, minus 4, 5. Okay. Then we have minus 2, sorry, I'll write it here, minus 2, 0, minus 4. Okay. Minus 2, 0, minus 4. So we have 0, 2, minus, no, we'll take, this is 45. I'll take like this, 45. 0, 2, minus 45. Then you have minus 2, 0, minus 4. Minus 2, 0, minus 4. And then you have 45, 4 and 0. This is the matrix. So it is 0, 2, minus 45. 0, 2, minus 45. Minus 2, 0, minus 4. Minus 2, 0, minus 4. And 45, 4 and 0. Okay. Now if you do the transpose, let us find out the transpose matrix. So AT. 0 remains as it is. This 2 will come here. 2. This 45 will come here. So it becomes minus 45. Minus 45 comes here. Okay. Minus 2 will go here. So it becomes minus 2. 0 remains as it is because it is part of the diagonal. This minus 4 comes here. So it becomes minus 4. This 4 comes here. It becomes 4. Minus 45 has already interchanged and this 45 goes here. So it becomes 45. So 45, 4 and 0. So if you see the transpose matrix, 0, minus 2, 45, 2, 0, 4 and minus 45, minus 4, 0. If you just compare this one with this one, original matrix, you will find that AT is nothing but minus A. Original matrix, the original matrix A, if you just make it negative, that means for all the positive numbers or the negative, if you change the sign, 0 will remain same, 2 will become minus 2, minus 45 will become plus 45. If you change the sign, you will see a skew, it will form a skew symmetric matrix. That means a skew symmetric matrix is a matrix whose transpose gives you the negative. Okay. Now let's go to, let me take diagonal scalar matrix we have done. I'll just take a small example. Some of you have requested me to take up scalar matrix. So we have done skew matrix, symmetric matrix and skew symmetric matrix. Scalar matrix, say I'll take a matrix, say, let's take 5, 1, 2, 7. This is a matrix and K is equal to 4. So K and this matrix say is equal to A. So Ka is 4 into 5. So the new matrix is 20. 4 into 1 is 4. 4 into 2 is 8. And 4 into 7 is 28. Okay, so this is scalar multiplication. Diagonal matrix we have done. Unit matrix we have done. Okay, now let us quickly do the determinant also. Few revisions on that quickly. Okay, so the determinant of a square matrix, let me take this, what is the determinant once again? The determinant of a square matrix is the integer obtained through a range of methods using the elements of the matrix. That means a determinant is a simple number which is associated with a square matrix. So we are dealing with a square matrix. Please remember this. Okay, square matrix. Now let us take the matrix minus 5, minus 4, minus 2, minus 3. Okay, we will find out the determinant of this square matrix. It is a 2 by 2 matrix, 2 by 2. So you can easily understand determinant will be minus 5 into minus 3. Minus 5 into minus 3. Minus 2 into minus 4. So minus 2 into minus 4. You know it is this way first and then this way. So you get minus 5 into minus 3 is 15. Minus 4 into 2 is 8. So you get 7. So this is the determinant of a square matrix. Okay. Now we take up singular matrix and non-singular matrix. Please remember it's very simple. If you have a square matrix, again a square matrix. Okay, a square matrix whose determinant is 0. If the square matrix determinant equal to 0, that means if determinant of a matrix A equal to 0, then this is called singular matrix. Then it is known as singular. Singular. matrix. If the determinant of a matrix is not equal to 0, that means if the determinant of A is not equal to 0, then it is called non-singular matrix. Okay? Okay. Also, last day we discussed about the commutative law. I am just quickly revising that as well. We had excellent questions coming in. I explained in detail about the fact that two matrix in general AB is not equal to BA. AB will be equal to BA only under three conditions: when A is equal to identity matrix, that is, it is of the form 1 0 0 0 1 0 0 0 1, or when A is equal to B, or when A is equal to B to the power n. Okay, so these are the three conditions. Transpose we have done. Now we come to adjoint of a matrix. We will take this and wrap up today, and let us take the revision of the inequalities on the next day. Okay, adjoint of a matrix. Now, adjoint of a matrix is nothing but the transpose of the cofactor matrix. Adjoint of a matrix is nothing but the transpose of its cofactor matrix. Okay, so let me just take a small example. Okay, so let us take A, matrix A is 1 4 0. Just do with me. 1 4 0 minus 1 2 2 minus 1 2 2, and we have 0 0 2 0 0 2. Okay. Now the cofactor, you know the first digit is A11, A12, A13, A21, A22, A23, A31, A32, A33. Cofactor calculation is, it's there in the study material, just revising once again. Cofactor A11, how to find? The formula is minus 1 to the power 1 plus 1. Okay. Ij, we know Aij. So I plus j. Here I is 1, j is 1. So 1 plus 1. And now we have to find the determinant of A11. That means you have 2202. Okay, so you have 2202. This works out to 2 2s are 4 minus 2 is 2, and you have minus 1. So it is 2202. You have to find the determinant of this. So 4 minus 0, it is 4. Similarly, this is the cofactor. This column is the cofactor column. Okay, cofactor. For A12, the formula will be minus 1 to the power 1 plus 2, I plus j. 1 plus 2 is 3, so minus 1 cube. And within the determinant it is 1, 2. So we will take minus 1, 2, 0, 2. Okay, so we will take minus 1, 2, 0, 2. This comes down to 2. So the cofactor is 2. In this way you have to go on doing for all these 9 elements. If you do it, you will get the final cofactor matrix will be like this. It will be 4, 2, 0. So 4, 2 is already done. 4, 2, 0. Minus 8, 2, 0. And 8 minus 2, 6. This is the cofactor of the original matrix. Now we have to find the adjoint. So the adjoint is nothing but the transpose of this matrix. So if you just transpose this matrix, you will get the adjoint. So adjoint matrix will be what? 4 will remain as it is. This 2 will come down. So 2 comes down, 0 comes down here. Minus 8 comes up, 8 comes up. 2 remains as it is, 0 will come down, minus 2 goes up, 6 is here. So the adjoint, ADJ, the adjoint matrix is 4 minus 8, 8, 2, 2 minus 2 and 0, 0, 6. Right? So this is the adjoint matrix, and last one we take up is what is the inverse of a matrix. Okay? So I think we have done many things today, like the other days also. In matrix also we have done some additional concepts. Singular matrix, non-singular matrix, what is adjoint of a matrix, what is cofactor of a matrix, and we are now doing the last one, inverse, and we have also discussed about the commutative law and other important parts in the matrices. So now we go to inverse. Inverse of a matrix. Inverse of a matrix means it is shown by A minus 1, inverse. This is nothing but the adjoint of the matrix A divided by the determinant. Okay. So adjoint, we saw, adjoint of a matrix is nothing but the transpose of the cofactors, as per the last example we saw. So adjoint matrix is the transpose of the cofactor matrix, and the denominator will be the determinant of the given matrix. This is what is called inverse. Also, please remember an important relationship. A particular matrix A multiplied by its inverse is always equal to identity. That is I matrix. That means it is of the form 1 0 0 0 1 0 0 0 1. Okay. So let me take the last one is inverse matrix. We'll just do the inverse matrix. Last one for today. It is 4:45. We are stretching 45 minutes beyond schedule time. I'm sure you are there. At least some of you are there with me, because we are trying to add as much value as possible even after our normal hours are over. So I'm taking up inverse of a matrix to an example. The matrix I'm taking is, say, P is equal to 1 5 2 0 minus 1 2 and 0 0 1. Okay. Now, if you see, this is an example of an upper triangular matrix because you have zeros below the diagonal. And if you find out the determinant of this, because the formula of inverse is adjoint A, sorry, P is the matrix, adjoint P by determinant P. Let us find the determinant P. Determinant of 3 by 3 matrix. First we will take 1 into minus 1 into 1, that is minus 1 minus 0 into 2, which is 0. Minus of 5, 0 into 1, that is 0, minus 2 into 0 is 0, plus 2, 0 into 0 is 0, minus 0 into minus 1 is 0. So we get, basically it is, this part is 0, this part is 0, so you get minus 1. So determinant of P will be minus 1. Now in this way, if you find out the cofactor, as I described, if you find out the cofactor of this matrix, that means starting from A11, A12, A13, okay, A21, A22, A23, A31, A32, A33. If you find out, you will get A11. The determinant will be what? Minus 1 square, minus 1 into 1, minus 0. So minus 1 square into minus 1, which is minus 1. Similarly, A12, if you calculate, is coming to minus 5. A13 is coming to, A21 is coming to minus 5, okay. A12 is coming to 0, A13 is coming to 0, A22 is coming to 1, A23 is coming to 0, A31 is arriving, the number is 12, if you solve it. A32 is arriving, we are getting the number minus 2, and A33 is minus 1. Okay. So, if you see, this is what we get as the adjoint. So, the adjoint matrix will be, so the cofactor matrix, if you just find out, it is becoming A11, you get minus 1, 0, 0, minus 1, 0, 0, minus 5, 1 and 0, 12, minus 2 and minus 1. This is the cofactor matrix. This is the cofactor matrix. Now to get the adjoint, you have to take the transverse. Right, so we just take the transpose, the transpose. So for the transpose, if you do, you are getting minus 1 remains as it is, 0 comes here, 0 comes here, minus 5 we are getting here, 12 goes up there, 1 stays, 0 comes down, minus 2 goes up here and minus 1 is here. So it is minus 1, minus 5, 12, 0, 1, minus 2 and 0, 0, 1. A mistake somewhere, minus 2 goes up, minus 1. No, this is 1 is going to stay, I think. Positive is minus positive 1. 1. Okay. So this is your, this becomes your adjoint matrix, and we know that the inverse matrix is equal to adjoint matrix P by determinant P, and we had already achieved the determinant P minus 1. So this divided by minus 1, that means the inverse will be minus 1 divided by minus 1 gives you 1. Minus 1 divided by minus 5 gives you 5. 12 divided by minus 1 gives you minus 12. Right? And then you have 0 by minus 1 is 0. 1 by minus 1 is minus 1. Minus 2 by minus 1 is 2. 0 by minus 1 is 0. 0 by minus 1 is 0. And we had, I think probably minus 1 here. Minus 1 by minus 1 is 1. Yes. We had minus 1. Right. So minus 1 by minus 1 is 1. So we get the inverse matrix 1, 5, minus 12, 0, minus 1, 2 and 0, 0, 1. So the original matrix, we found out the cofactors. Then we transposed them. We got the adjoint matrix, and the adjoint matrix divided by determinant gives you finally the inverse of the matrix. So dear friends, it is 4:50 now, 50 minutes. So I think we stop today here. We have done a lot of work. We started with the time value of money. I'll quickly recap. We did discussed about what is time value of money, what is interest, why interest is paid, the types of interest, simple and compound interest. We saw the differences between simple and compound interest. Then we moved into number of numericals from the study material from past examinations on simple interest and compound interest. Then we moved into the compounding periods, the conversion periods. We saw and solved number of numericals on the conversion period where the interest will change and the n, that is conversion period, will change. After discussing that, we completed almost 10 examples, and then we moved into matrices. I responded to many of your queries, almost 45 queries. I have responded and I have documented that. And then we took up matrices. We discussed about singular matrix, non-singular matrix. We had the skew symmetrical matrix, the symmetrical matrix. I discussed once again about commutative laws. We did the determinants once again, and we discussed about the cofactor of a matrix, the adjoint matrix, and how to find out the inverse of a matrix. Right? So we complete here today. Thanks a lot for being with me and being part of this session. Next day we will start with the time value of money and proceed on to some of the more practical examples of time value of money, like annuity, sinking fund and all, so on and so forth, present value and all. We will do more numericals, and next day I will also complete an additional part of the inequalities where I will take up 1 or 2 examples from the graphical method of completing inequalities. So with this, we come to the end of this session. Thanks a lot for being with us. See you next day at 2 o'clock on the day after tomorrow. Till then, take care and stay safe. Signing off.